Air Canada has been flying high lately, and that is great. However, is there a crash on the horizon for Canada's top airline? Fasten your seatbelts and make sure those trays are in the upright and locked position. This is going to be a good one. Ever since the pandemic, one question I have heard time and again is about if it is time to start buying Air Canada again. That time is more than likely past. The under $17 share price may not come back. However, they are still pretty cheap, and that question should be, does Air Canada's fundamentals support an investment? No worries, I do have the answer to that question. As Canada's primary flag carrier and its largest airline, Air Canada has a rich, illustrious history that stretches all the way back to 1936. Initially operating as a government-owned entity, the company underwent a transformation back in 1988 when it was privatized, marking a new phase of expansive growth. Over the decades, Air Canada has grown its fleet, extended its routes, and broadened its global reach. There have definitely been some stormy skies to navigate, such as, 9/11 and now the pandemic, which they are still currently recovering from. In fact, those fundamentals I mentioned earlier will absolutely reflect that recovery. Join the conversation. Let us know in the comments if you have flown yet since the pandemic. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. Air Canada's share price has been moving in the right direction, and that is fantastic for an investor. They have a strong management team and a very solid footprint in the industry. On the surface, this absolutely looks like we have blue skies ahead. However, I think I do hear some rumblings in their fundamentals, so as always, we're going to need to enlist the help of our good old friend, Mr. Math. We will, of course, start with some surface data. They have a market cap of $8.89 billion, and their beta is pretty high at 2.34. That means they're more than twice as volatile as the market average. Their earnings per share, well, that is in the negative. It comes in at negative 202. Now, the last time we looked in on Air Canada, that was back in January, that EPS was at negative 12.50, so they have improved quite a bit. There are flashes of silver in that dark cloud they currently reside in, for sure. Their price to earnings ratio, that comes in at negative 12.70. The average for their sector is 0.70. Their PE ratio was also pretty darn low. It was negative 30 back in January. So once again, we are seeing a trend in the right direction. Their price to book ratio, that comes in at negative 6.10. The average in that sector is 2.40. We do not have a return on equity for them. That doesn't necessarily mean it's bad, but considering the negative territory we're in, it's probably not good. Let's take a look, though, at their cash. Their revenue came in at $18.87 billion. Those earnings, though, they are in the negative at negative $722 million. Now, those earnings are actually projected to increase by 42.81% per year. This is really good. They are going to need those extra earnings to keep everything going in the right direction. Their free cash flow, that comes in at $1.69 billion. This, too, is much nicer than last time when it was negative $210.38 million. Their operating cash flow also in the positive at $1 billion. When we take a look at their fair value, their current value at the time of recording was $25.58. Using a discounted cash flow model, we get a fair value of $68.12, meaning they're undervalued by 62.4%. That's not too bad. Even with significant dilution at the beginning of the pandemic, it does look like they have plenty of room to grow. However, before we throttle down, let's look at the returns for Air Canada. Air Canada does not have dividends, so we're going to jump straight to returns. When we look at the 3-year, their price rose from $16.44 to $24.80. That is a return of investment of 50.85%. Not too shabby. When we switch to their 1-year, their price rose from $16.97 to $24.80. Once again, a good return on investment, 46.14%. And in 2023, their price rose from $19.68 to $24.80. That is a return of investment this year of 26.02%. These are great. Return-wise, we are seeing really good numbers, and we do need to see these trends in their price continue. I think when we switch over to their debt, you will get a better understanding why these increases in everything from their share prices to their earnings is really important right now. Air Canada has a total debt of $13.11 billion, and their total equity comes in at negative $8.52 billion. That gives us a debt-to-equity ratio of negative 866%. 6.2%. That debt was at $13.88 billion in January, so they have paid it down a wee bit. Unfortunately, that has come at the cost of some of their equity. Thus, their overall debt to equity ratio is worse now than it was back in January. Keep in mind, before the pandemic, they had a debt to equity ratio of 131.4%. If you think the pandemic only mildly affected the airlines, you're definitely mistaken. The effect of the pandemic was big time. Another small little glint of silver in all of the storm clouds up in the sky right now is that they do have a little bit in their cash and equivalents. They've got $8.52 billion there. Let's take a look at their short term. In the short term, their assets come in at $10.28 billion and their liabilities come in at $10.39 billion. Long term, those assets come in at $20.20 billion and the liabilities come in at $20.16 billion. Air Canada's debt situation will no doubt scare away many investors. They have negative shareholder equity, which is a very serious situation and in fact can be worse than just high debt alone. Air Canada is not treading water. They are still drowning, but they are very good at holding their breath. So what is the final verdict? The negative shareholder equity is a huge, absolutely huge negative on this stock. However, there are also a lot of positives. The big positive is that they have deep enough pockets to maintain for more than 3 years. And at the same time, most analysts believe they will be profitable within those 3 years. With the growth in their earnings of 42.8% per year, that is possible for them to accomplish, provided they can maintain that growth rate. Another good sign is that there have been no dilution in the last year and no significant insider selling, which is basically showing us the people working for Air Canada are starting to feel a little more confident in their company. With no dividend, this is obviously a hard pass for passive income investors. Growth-wise, this is not a bad long-term investment. Air Canada will become profitable again, and the journey to that profitability will more than likely come with a lot more share growth. Even though I feel confident in Air Canada, I still have to caution that this is a long-term investment that needs a little extra monitoring just because of that negative shareholder equity. In 2023, they did exceed analysts' expectations in Q1, and with their Q2 earnings, I am expecting to see more of the same. Of course, before you jump into Air Canada or any stock you see on the YouTube, make sure you do your own research before you plop any of your own hard-earned cash on the table. Keep the learning going. Watch my video on big return little stocks linked on the left, or test YouTube's recommendation skills by checking out the videos on the right. Your choice will decide the winner, and I will see you in the next video.